There are really three types of loans. There's an operating loan, there's intermediate term loan, and there's a long-term loan. So an operating loan is used for operating purposes. It's typically set up on a one-year basis, and it should flow with the operating revenues and expenses of the farm business. So as you have revenue, the loan should get paid down. As you have expenses, the loan goes back up. What we really don't want to see is for someone to take a $100,000 operating loan, run it up to the max on day 2, and then never pay it down. A year from now, it comes time for renewal, and you still owe $100,000 plus the accrued interest. It really needs to go up and down through the year. It can also include family living costs. If you're a grain farmer, you may have a lot of expenses paid early in the year, and you don't have any revenue until November or December. But you have to live on something in between. And so you can use the operating loan to cover family living costs. That's a legitimate use of an operating loan. But we want to see that operating loan be paid off with operating revenue. So that's an operating loan. Those are typically, we set those up generally on a one-year basis the first time that we provide an operating loan. We want to make sure that it's performing well, that you're able to handle it, that it's what you need and it fits your operation. If everything's successful, then we may set it up for a multi-year operating loan. So that's an operating loan. Intermediate term loan is generally from 3 to 7 years. It's used for purchase of equipment, it's used for purchase of breeding livestock, could be portable buildings, things like that. Those are set up on typically with a regular monthly, quarterly, semi-annual, or annual payment. It's got regular principal and interest payments. It can either be on a fixed rate, which means that the rate is fixed the entire length of the term of the loan, or it could be on an adjustable rate. So you might get a 3-year adjustable rate, which means the interest rate is locked for the 3 years, and then whatever the rate is at the time that it comes up for renewal, that's what the rate will reset to. The last loan is the long-term loan, and that's for real estate, or it could be for construction of buildings. So when we write a long-term loan, we can write up to a 30-year fixed rate, which is really unusual. That's really one of the competitive advantages of the Farm Credit System, is because of our funding source, we're able to lock in that sort of a long-term interest rate. So that's a huge advantage. Most banks will only write maybe a 3-year or 5-year adjustable rate, if they'll even loan to farms at all. With a 3 or 5-year adjustable rate, you're vulnerable to changes in the interest rates over time, when it comes up for renewal. So having that 30-year fixed rate is great. And with that 30-year fixed rate, we offer a conversion option. So if rates go down over time, you can ratchet your rate down by converting. You have to be in that rate lock for 1 year, but once that's up, if the rates are 1% lower, you can pay a $500 conversion fee and lower the rate to whatever the current rate is, and that'll lock in for the remaining 29 years of the loan. If you have another opportunity in another year, you can do it all over again. So you could ratchet your rate down over time, but the day that you sign your loan, you're never going to pay a higher interest rate than that day. Usually the length of the term is anywhere from 15 to 30 years. And so really, real estate is the main reason that we make a long-term loan.